All right, Matt Davio, Mistrade here with Keith McCullough. Keith is a interesting guy. I think I've read about you in the past, but I ran into your book recently at Barnes & Noble, Diary of a Hedge Fund Manager, and I bought it and read it real quickly. And this book has only been out probably, a month? Early January the book came out?
Yeah, it came out early January.
So, fascinating read, and what I liked about it, Keith, is you were down and dirty, honest. You didn't really come from the traditional, money background. Talk a little bit about you're Canadian. You're born in Canada.
Yeah, born and raised in Thunder Bay, Ontario.
Thunder Bay.
So
that's a great area, and I've spent a lot of time up there on the Lake Huron. Growing up a Michigan guy myself, I've spent a lot of time up in the Lion's Head in that area, so that's not far from that whole segment. Beautiful, beautiful spot.
Yeah, it's a beautiful part of the country. I have a house up there now, and we go back quite frequently. So I don't stray too far from home.
So there's a couple things that you and I have in common. You're a hockey player. I'm not a hockey player. I'm an amateur. You are a hockey player. You played some college hockey. You actually played some pro hockey before you went to college on a hockey scholarship. So talk a little bit about growing up in Canada and how hockey parlayed a Wall Street future. So again, you're finance, obviously a hedge fund guy. You're into hockey, and now you're on the sell side, and we'll talk about that product in a little bit. But tell us a little bit about your life growing up as a aspiring hockey pro, and kind of where you went from.
Well, if you want to get some early training on being on the road, following companies, and doing good research, the best training is to be on a Canadian junior hockey bus. And I'm from a town that's in the northern part of Ontario called Thunder Bay.
Yeah.
So we basically had to be on the bus everywhere, all of the time, and. Yeah, I left home when I was young, so like when I was 15. So I got used to being on the road and being on my own a lot. And it's kind of transfers pretty well into the investment business because you're alone a lot. You're alone to your own thoughts a lot, as you know. Yeah. But you're traveling a lot too, doing a lot of research.
15, talk about that because most people don't recognize that junior hockey does start really, 14, 15 for a lot of the top-notch players. So obviously you were in that echelon. Growing up in Detroit, I had a lot of friends that did the same thing. Left the Detroit area and went to the junior leagues in Ontario primarily, and there was some in Detroit. But the top tier stuff always was in your woods. And again, you were probably, like you said, you were probably traveling 300 to 500 miles in between spots and where you were playing. There's some broad territory being covered.
Yeah, there's a ton of ground to cover, and it's cold and it's lonely, and the only way to do well is to win and to put the puck in the net really when you're on the ice because it's really not it's not exactly warm either, by the way. So you're just kind of, and being away from home too is not exactly easy. Yeah. But I got used to it.
So this was a passion of yours. Again, you weren't I think in your book you mentioned, hey, my parents weren't necessarily pressing me. It was just something that you had a drive inside of you to do this. So you obviously had the skill set also. What did you learn from that experience? And obviously at that young age, you definitely were tracking in the right way, and then you ran into some injuries.
Yeah, it's an interesting exercise, like in terms of training, if you will, for Wall Street, because you're really left to your own convictions and your own devices. When you're that far away from home, and I played like 15 hours away from home by car, and since I wasn't, my family, wasn't from, a ton of money or anything like that. My dad is a firefighter and my mom's a teacher, so I couldn't like fly home in between games or on the weekends or anything like that. I could only really be home for Christmas, and that was it. So really, you learn how to bet on yourself. You learn how to, like I said, be confident in your own ability, because really at the end of the day, there's nothing else left. There's nobody that owes you anything in any of these Canadian, junior hockey buildings. I can assure you of that. There's plenty of people out there who want your job. They want to play and they want to get drafted ahead of you. And it's extremely competitive, not unlike Wall Street.
Right. And you were drafted, were you not?
Yeah, I got drafted by the Windsor Spitfires, which is, by your neck of the woods.
South of the border of Detroit, exactly.
Yeah, exactly.
Most people don't know the best trivia question I always like to throw out is, what is the first country south of the American border? People always go, oh, it's Mexico. No, it's actually Canada, because Windsor is south of Detroit. So
yeah, it is.
When you take the bridge over, or you tunnel over to Windsor, it is south of the border.
It's not a big resort town, but it's a hockey town.
Did you spend any time in Windsor?
I did. I went to training camp, actually. I went to the way that it works in junior hockey is you got to make a decision within 3 days, or you lose your college eligibility.
Right.
So that's actually tough too for kids, because you really have no guidance on that. The peer pressure obviously is extremely high to play in that league, because that's really the feeder league to the NHL, and that's where all the best kids play. So you're there for 3 days and you have to make a call on your life, and really that's it.
Has that changed at all in hockey? Because it has, if you look at the Michael Lewis book Moneyball, I mean, it has changed somewhat. And kind of the mindset is, hey, I'm not looking for the 100-mile-an-hour 17-year-old anymore. Is it kind of switching that way? Again, I'm a Michigan guy, and Michigan hockey with Red Berenson has definitely been a great program for a lot of kids coming from all over Canada and the U.S. who have decided kind of, hey, I'm going to get that education along with a potential maybe to build my skills under Red's program. Do you think that's changed at all in the hockey world?
Yeah, I definitely do. There's a couple things that have changed. There's the education and the information transfer. It's been associated with that. A lot of players have just, through the internet and YouTube and whatnot, been able to really exercise and understand what it is that those opportunities are. And I think for a long time, at least when I was growing up, in the 70s and the 80s playing hockey, right, you didn't even have that, right? So you couldn't get your name out there. You didn't know what was out there. You didn't know what the value of an education could be. There was no testimonial unless a guy who went to college literally was from your hometown. So, the resources is a big part of it. And the other thing, which I'm sure you would respect and understand, is that the NHL in particular has moved away from I used to call them the Q-tips, the guys with the big head and the big heads and the big feet, the big guys. Yeah. And it's gone back to a finesse game, with less clutch and grab, which really augurs and, anchors, well on the college front. So there's a lot of college kids that are making it to the NHL today, and I think that helps too.
Yeah, I agree. So, how did you end up at, and you run your business from New Haven. So tell us how you got over to Yale. Again, you're up there, playing in Northern Ontario. How did you got injured, and how did you make that transition? How did the coach find you? How did you find the coach, and how did you make that transition over to college hockey?
Well, if there's one market system up north of the border that's efficient in terms of people figuring out what's worth something from a talent perspective, it's the Canadian Junior Hockey League. And at the end of the day, you play in front of a lot of scouts every night. As you mentioned, I got hurt the year prior, so I was kind of damaged goods there for a little while. But, I started, recuperating and played well in front of Tim Taylor, who was at the time just coming off his stint as the U.S. Olympic coach. And he saw me playing. I guess he obviously thought that I was, at least reasonable enough to look at. And that's how it really happened.
Okay. And had you considered, at that point, going the college route?
Yeah, I'd been considering going to college for quite some time. Again, my mom's a French teacher, and then subsequently became a principal. So the entire side of my family, is education oriented, and that was always important to me. I just never knew what I'm telling you, like flat out, I had no idea what Yale or Harvard really was. Right. I was just kind of a bumpkin in that regard. And once I started to get recruited, obviously I started to, figure it out, but I really didn't aspire to go to Yale or Harvard or Princeton or anything like that.
Yeah. So again, when you landed at New Haven, you were on a team that was not so having too much success. When you joined the team, weren't they a losing program at the time?
Yeah, it was terrible. We my first year at Yale, we had 6 wins, and you play roughly 30-35 games a year, so obviously things were not good.
And what was that experience like, coming from the high pressure of the Canadian juniors, jumping over to the college level, which is very competitive, and you're playing at the top notch still with the the East Coast schools, whether it's CCHA, ECHA, they're all great programs, and there's only so many of them here in the States. So what was the talent level like when you jumped to that league?
I mean, the talent was, right what the doctor ordered, really. I mean, it wasn't a huge surprise to the upside or downside to me. Again, I'm from a hockey town. There's 9 NHL kids currently playing in the NHL right now from my hometown, and it's a small town. So, I'm used to playing against a pretty high caliber of talent, but it was right in line with what I thought. When I came to Yale, what was a bigger surprise to me was just the overall kind of complacency associated with just being in the league. It wasn't a real winning program or a really, very much a winning attitude at all. So we really turned that around, and that I think was probably the most obvious thing that I recognized when I first got here.
Where do you think that turnaround came? Was it from the players, coaching change, coaching staff? What happened?
Well, Coach Taylor, Tim Taylor, been here for almost. By the time he left, for almost 30 years. So, I don't think that, it was ever going to be a coaching problem. I think it's the kind of players that inspire a coach to be a great coach and vice versa. I mean, you really need both to be working together. These units need to believe in each other. And I think we got Taylor to believe that we weren't, I think when I first got to campus, he said, you can't win a horse race with a bunch of mules. And I think what he started to believe was that we had some horses in the barn, and we started to run with them.
Well, and that's so true. It's so true, especially with, like you said, there's so many lines in hockey that have to participate, and it's such a team sport. You can't have a Wayne Gretzky and win still. You have to have, it's a total team effort from goaltending, to the fifth line even. So tell me a little bit about, this I would call it a trade-off that you made in your life. You kind of gave up the pro dream when the injury happened. You ended up at a fantastic educational opportunity. As you said, your mom was an educator, and I find a lot of traders, by the way, have one or both parents that came from educational backgrounds. So I'm curious what your curiosities were as a child beyond hockey. What were you interested in? What did you favor to read? What did you study? What did you just as a young kid? Even when you're on the road, what were you reading? You had to be doing something.
Yeah, I was. I'd say that I was one of the more peculiar guys on the bus because I would always be reading. Like reading's always been a passion of mine. Reading nonfiction specifically, to the point where I refused to read a fictional book. So I had a passion to read, and I read a lot. Like today, I read probably a book every 9 to 10 days. But I think I picked up those habits being on those buses, left to my own devices back in junior hockey. So, that's probably where the root of it came.
What kind of stuff were you reading, as a young adolescent into your college years?
Well, I started when I was, you're a hockey player, right? So I started reading autobiographies of hockey players and then all of a sudden I started picking up other, kinds of stories about other athletes, and then that would broaden into people that were successful. So what I was fascinated with was that, success across disciplines, whether they be music, an accomplished artist, an accomplished hockey player, football player, tennis player, had very uniquely similar characteristics in terms of their discipline and drive. And I still to this day I find that to be a very interesting kind of analogy to make amongst successful people.
So what were some of those factors that you started gleaning onto? What were some of the was it persistence? Was it obviously skill had to play a part of it, luck? What do you see as being the drivers in making people successful? And it doesn't matter, again, I agree with you. There's got to be an innate skill, but there's also got to be a drive to want to learn and educate and re-educate yourself. And you know this very well as a trader and as a hedge fund manager in the past. There is no holy grail. So how do you define what makes people successful? And you probably were learning a lot about that, again, on the ice and reading some of these stories. And what were you taking away from some of these stories?
The unwavering demand to succeed at all costs. I mean, and seeing that adversity, is born in a lot of different faces, but in a lot of different places too. So, whether I'm reading about a Yugoslavian tennis player or reading about, a colleague who played hockey who's successful, it's always the same thing. That those people who had the ability to stand up and say, no, I'm better than that. I'm better than you think that I am. And if you don't think that I am, I'm going to prove it to you. And I'd say that that's definitely one of the big ones.
Do you think that that's why? There are so many hyper type A competitive former athlete personalities, I think, that get into the financial markets. I mean, when you went to school, what did you think you were going to study, and what did you study?
Well, I had no idea what I was going to study, first of all. So I showed up at Yale, and I showed up in my first English paper. I remember today, and a lot of people, chuckle when I say this, but my first paper at Yale was deemed ungradable by the English professor in the English department. So that kind of took the wind out of my sails to be a writer. I've kind of turned that around, so to speak. But I immediately went to the business courses and started to really dig in on the economics side of things. But again, even at Yale, thinking about the economics courses that I took, there were very few that were as practical as maybe Robert Shiller. I mean, I had a huge opportunity to learn from an educator who put his theory in practice, if you will, like Shiller did. Yeah. Calling crashes was really what he was talking about, and that really sunk in with me. So then I think that's probably when I started to bite on the economics side of my studies and really go with it.
So Shiller talking about boom and bust cycles is still a topic he loves to talk about, and loves to do his he's still doing his housing indices. When did you start considering trading as a future, as a career for yourself?
Well, I got an internship again. Luckily I got an internship with another hockey player, a guy who was named Tiger Williams, who was at the time just starting his own firm called Williams Trading, but he was Julian Robertson's head trader on the domestic equity side for quite some time. So I had a tremendous opportunity as a junior in college in the summer, working in New York City and learning exactly what trading was with a very hands-on experience. Okay.
So you did that, was it sophomore, junior summer?
Yeah, that was junior going into my senior year.
Okay. And then from there, were you hooked? I mean, did you know that's what you wanted to be when you grew up? Be on a trading?
No. I was still a hockey player. I don't think that I realized till I was literally within 10 games of my final game that I ever played as a hockey player at Yale that I wasn't going to be a hockey player. I came to grips with it well after the fact.
Okay. So, again, even after your college years, you were thinking, hey, maybe the NHL is still going to call me up, and I'm going to be playing 3 times a week all over all over North America. Is that what you're thinking? I mean, really? Never gave up the dream.
Yeah, the hope was there, but as I like to say in investing, hope is not an investment process. So, I was realistic. I'm 5'9", and I don't think I had grown since I was 16 years old. So, odds of growing was just a hope. And I also like the idea of retiring on my own terms. At the top of my game, as opposed to being somewhere in the East Coast Hockey League, kind of dredging around.
You didn't want to be on the Hampton Roads Generals, huh? My mom's cousin's a general manager of that. I just threw that out there. So, anyways, so you graduate. Did you graduate with the econ degree? Is that what you got from Yale?
Yeah, I had a BA in economics.
So you and I have that in common. We both are econ grads. And did you go to Wall Street right away?
Yeah, I went to CSFB. So at the time it was just First Boston really was the dominant driver. Frank Quattrone was running the banking side of tech there, and things were literally going berserk when I showed up there. So I was thrown right into the fire.
I bet.
1999 was the year.
So 99, you're out and you're working right there in the heyday. Talk a little bit about risk reward. Working in a shop like that, and coming from again a game where you're used to risk and reward of moving around the ice and shooting the puck. What do you think, what skills and traits did you bring into the business that you think benefited you immediately into this game?
Definitely work ethic and persistence. And at the same time, work ethic and persistence in an environment where everybody thought that they worked hard. And you realize pretty quickly that not everybody on Wall Street works hard, and not everybody is consistent. So when everybody says they're doing that, I found it to be a tremendous opportunity to actually set a standard for that. That works itself in many different ways. Discipline can be, putting yourself in bed early, not doing some bad things that you could be doing in New York City, as a young 20-year-old. And there's a lot to it, and you just got to get up every morning and do it. And I figured that out pretty quick.
That's cool. So, again, you're there 99 through 01. You saw the markets crash, the bubble crash. What were your perceptions, and were you still at Credit Suisse when that happened?
My main takeaways were that the reactions were much different than in the hockey dressing room or in the hockey world. Because when you lose as a hockey team or there's some adversity as a team, generally speaking, the solution isn't to point fingers. But what I learned on Wall Street, there's a tremendous amount of individuality. And what thankfully I figured that out very quickly, because what you learn is that it's every man for himself to some degree. And when things start going the wrong way, the fingers start to get pulled out and pointed. So that was an important lesson to realize right out of the chute.
Even within the same team, I agree. It's a vicious, nasty place. I mean, you're still kind of in the, you've stepped away from the business on the hedge fund side of it, and I'm out of it probably for similar reasons. I don't miss that. I don't miss, guys that you thought were on your same team chopping at you every night. I mean, these are supposed to be your teammates. So it is a nasty, vicious place.
Yes.
And I don't think that'll ever change. It's, it's the heart of and the root of capitalism and the way it functions, and I think it has to be that way, unfortunately. But it can get nasty sometimes, and it's not the way I want to do business. So let's transition. How long were you at Credit Suisse, and when did you start running your own fund?
I left, so it didn't take me long to realize I didn't want to play in the dressing room full of like a lot of individuals. So I was gone like literally inside of a year and a half. After a year and a half, I was gone. I'd gotten hired by one of our clients. The hedge fund business, as you know, was really taking off at that point in time, and a firm called Dawson Sandberg was splitting up. Art Sandberg was leaving to start Pequot Capital, which at that time actually was becoming, I believe, one of the largest hedge funds in the world, next to Tiger Management and Soros. So I thought it was a huge opportunity to go to the Dawson side, where they really had a dressing room that was empty all of a sudden. And it was a client that I knew and a client that I respected. So I made that move in early 2000. And
how was your time there? How'd you go? How'd you like going to the inside the hedge fund world?
I really enjoyed it. I mean, what I loved about it, again, much similar to hockey, is that if you could perform on the buy side at a hedge fund, you were going to get responsibility. You probably got enough responsibility to hang yourself with way too early, and you know what? That's the way that it works. People turn and get turned over pretty quickly on that side of the coin. But I learned pretty quickly that if I could put points on the board and I could come to work every day and show some level of success, that I was going to get more and more responsibility, and I got that over 5 years, which is basically what I stayed there for.
What kind of things were you trading there, Keith?
Mostly consumer stocks. So I think they gave me the easiest group to model from a financial modeling perspective is a retailer, or the retailers. So they gave me the retailers, the restaurants first, because it's not trivial, nor are the channel checks or understanding those businesses. So, they didn't give me biotech or anything complicated right out of the chute.
Yeah. And so, what did you learn from your time in that space? Because that is, like you said, it's pretty upfront. It's like, what are your sales? Are you growing? Are you slipping? Where are you? What are the new products coming out? How are you going to grow your businesses? So, pretty straightforward.
Right. What I learned in that, analyzing those companies, is one, very cyclical. Two, winners become losers very quickly, at least in Wall Street's eyes, because you have to. You have to, as they say in retail, you have to comp the comps. So when you have a good run, you have to bump up against it the next year, and it's very difficult to put up good numbers after good numbers, because again, these are cyclical businesses, and a lot of people, mistake them for other things. Yeah. So that's something that makes it a really exciting group to follow, because the winners and losers are always changing.
Right. It's absolutely. The trends are fast and furious in that space. Absolutely.
Right.
So 5 years, and did you cover some other areas and trade some other areas while you were there at Dawson?
Yeah. Near the end, I started following metals and mining and started doing more and more macro work, which I do a lot of today. Yeah. And really, it's interesting, because those three things that I did, first the retailers, I covered Walmart, then I started doing metals and mining and some macro, really led me to my first kind of trips to China and understanding what Walmart was doing in China. Understanding what some of the supply demand issues were and stuff like copper in China. So I really, at a young age, was exposed to some international travel and doing some primary research on that front.
So you were over in China, 03 through 05, and somewhere in that time frame?
Yep, exactly. I was on the road a lot. That was probably the most, at least the most valuable part of my experience at Dawson, was that they, let me travel and do my own research at basically my own will. I think one day, one year I was on the road 256 days doing basically 256 meetings with different companies in 1 year.
Wow.
So again, that's probably not a job for me with a family today.
Right.
But as a young, in my mid-20s, that was definitely the right job.
Let me ask you, what was your biggest impression over your, in your time over there spending in China and traveling wherever you may have gone?
Well, what I learned, like traveling, what I came to the basic conclusion was that investors were all alike. Whether you're in Europe or you're in South Dakota or if you're in, New York City or in Shanghai. I mean, at the end of the day, investors' fears and worries, and greeds are all very much the same. So that kind of, behavioral side of markets, if you will, definitely transferred across languages and borders.
So the follow-up question to that would be, would you consider yourself very fundamental driven at that point of your life, spending 5 years traveling and visiting with companies? Fundamentals versus technicals. Is there a balance when it comes to that behavioral economics, behavioral finance? Because I agree with you. And for me, the chart ultimately tells me everything that spending all that time in front of those 256 companies does. That's my belief.
Yeah, well, the chart tells you that, if you didn't know, now you know. The chart is a picture that on a revisionist basis paints what you missed or what you got right. I think over time, and I learned this, a guy that I worked with, Russell Herman, taught me this. He basically said, take out the chart, take out a historical chart and show the big moves in the company's stock price and explain it away with what actually happened. So you go back and you are a revisionist historian to some extent, understanding why it is that asset prices do what they do. And if you can become a student of that, a student of history, I wouldn't exactly, sometimes I feel like we're being, talked down to when we're called, people are technicians or quantitatively oriented or whatever it may be. I actually think it's quite the opposite. If you can combine what's happening in the charts and what's happening from a quantitative perspective with the quote unquote fundamental research side of things, you could tell a lot more about a situation than not having all those tools at your disposal.
I agree. I think one versus the other alone is not substantive, and I think very easily. I think the charts are very forward-looking always, and you may not know what's coming, but you can tell by a chart. You can tell that gold broke in December. I can tell you that the S&P has broken over the last 2 weeks. These are just major changes. I can't tell you why they're breaking today. I can't. I mean, fundamentally, I cannot tell you why, but there's something that's coming down that is leading us to this deflationary pressure, whatever that may be, and we'll see what history will tell us fundamentally down the road. But I think price always leads us one way or another, and
absolutely. And today, today I always say this, but prices don't lie, people do, and Wall Street really lies, in terms of telling a story that's not matched up with price action. Absolutely. So when I wake up every day, I also say to my team, prices rule. Yep. The price is telling you exactly like you just said. The price is telling you that you don't know something, or that somebody thinks they know something.
Exactly.
And the art is taking advantage of people who are acting on something that they think that they know that isn't actually accurate. Mm-hmm. Now, those situations are really, really interesting to find because they're very unique. But quite often, and more times than not, what people actually are seeing in the price correlates with what's actually going on.
Yes, absolutely. Yeah, and for a majority of the time, we're just trending one way or another, and you just need to stay within that trend. But during these periods of a change of direction, change of trend, or change from a trend to no trend, these are the periods I think where the greatest opportunities lie to make the biggest money, because if you're aware of these things and place your bets properly, these quick changes can make you a boatload of money. And this is where, again, that economic behavioralism, I think, feeds on that fear and greed. When people are most greedy is when, I want to sell it to them. When they're most fearful, I want to buy. I mean, that's a simplistic view, but when it comes down, if you can find those turning points, whether you're looking at an intraday chart or a weekly chart, doesn't matter. When you find those, dial into them and take advantage of them.
I completely agree with you. There's we talk about duration mismatch a lot, but if you can understand that if you can be duration agnostic and understand those changes that take you from one duration, a short-term duration, to, as we call, an intermediate-term duration. We actually label these things trend and trade. When something moves from a trade into a trend, you absolutely have to be on top of that, no matter what you think or thought or might think that you could have thought. Right. At the end of the day, when a price starts to move from a shorter-term duration to a longer one, a lot of different investors with a lot of different investment mandates have to make new decisions that they hadn't made before. And at the end of the day, that's really, to your point, I think that's where you capture the most returns, is understanding what happens on the margin as you're switching from one to the other.
So, again, you're a macro guy. I love this stuff. You've been in the sectors. You're a fundamental guy. Now I hear a lot of, I like the charts. So, and let's talk a little bit about you left Dawson, obviously started your own fund. What was that experience like? And what kind of assets did you start with? And you talk about this in the book, but I don't want to give the whole book away because it is, anybody interested in running money, again, I always this would be a type of book I would recommend because it's like Pitbull. It's like, hey, you've run money. You've been there. I've done it. I've been there. I don't want to be back in that running money business. Sounds like you don't want to be there right now too much either, and that's why you're offering a sell-side product. So walk me through. You kind of run through. You're fairly young. You're younger than I am. I graduated in '88, so I'm a decade before you. But I only spent the last 15 years, so I kind of came into this business backwards. You came in right out of college, but you kind of had that same timeline, very quickly running through in a decade of working for a firm, running your own fund, and now you're on your own product. So let's touch on going from a firm hedge fund to your own hedge fund, and then how you got from there to writing the book and then to HedgeEye.
Sure. One caveat, though, we Canadians come to Yale as 25-year-old freshmen, so I'm probably closer to your age.
I forgot about that aspect.
Canadian hockey players have a special privilege. I'm joking. But I guess, what I did in 2006, we launched the fund. It was called Falcon Henge Partners. My partner and I from Dawson, a guy named Harry Schwefel, who now works at SAC Capital, he and I started the fund very successfully within the first 3 months, and this really speaks to the hedge fund bubble that we were in. We had a couple larger hedge funds, basically saying, hey, why don't you fold your fund into our fund? We've just raised a boatload of money. You guys, it's going to take you a little longer to raise that kind of money because you're younger. You haven't, had your own fund before. So that was actually an interesting time. One, because we're sitting here, putting up plenty of points, and it would be the equivalent of being the top scorer on a team, and all of a sudden, the market's, full of these fund-to-fund guys that are asking you why you're not, chasing momentum stocks and why you're not, doing this, that, and the other. And us, we're having a good run anyway, and the offer was on the table, so we took it. So in the second quarter of 2006, we ultimately, folded our fund into Magnetar Capital, which is the guys out of Chicago that used to be at Citadel. So it was a pretty quick dose of being my own hedge fund manager, if you will, and we moved on quickly from there.
Well, I mean, again, great trade. Good for you. I mean, that I can tell you that was my goal. I was 03 through 06 running my fund, and again, out here in Bend, Oregon, I was very, very small. I didn't come from the inside like you did. Didn't have the assets under management that I'm sure you did. I was maybe pushing 25 at the end, and I was also running a short bias fund when in a time when everybody was doubling their money in real estate every day. So it was a tough fighting against that economic phenomenon that we will not see for another 3 generations. But
back in that 2006 was big time. I mean, that was the bubble, the hedge fund bubble.
It was.
I mean, so when we moved to it's just a sign of the times. You get a multiple $100 million book, but basically, for me, I was in my early 30s. I mean, this wasn't exactly chump change to be managing.
No, not at all. And again, like you said, these were numbers that a decade prior would have put you in the top percentile. And now, there was guys like you, and not me. I wasn't that big, but guys, a ton of guys with $100 million under management. It was mind blowing, and it was a bubble, and I saw that too. I was like, wow, I started 03 a little early maybe, but by 04, 05, I was like, man, this is just getting crazy. The money that was being thrown to some of these folks. That transition, I assume you worked there for a while as they purchased you, and then when did you leave?
I stayed for just inside of a year, so I ended up at the Carlyle Group. So then the Carlyle Group was looking to raise their own hedge fund, because Blackstone, I guess, had just done theirs, and there was plenty of talk that these big private equity guys were going to go public, obviously because Blackstone was going public. So I ended up at the Carlyle Group, basically they made me a partner right out of the gate, and I was on their investment committee on the long-short equity side. So that was in early 2007, and we opened the fund in April of 2007.
All right. And then how long did you stay at Carlyle?
Basically, I left Carlyle in November of 2007, so I got let go in November of 2007, which I go through in the book, which is really the genesis of the book. Is the book starts from where I got fired, basically, which was November the 2nd. I got let go. It was plain as day the reason why I was not making money. For me, that was a new situation. It was kind of like being in a slump, from a goal scorer's perspective on the ice. You know that you're not going to be in a slump forever, but you can't control, the clock. And I was really bearish. And I said to myself, okay. I sat at the table and I said, I think you guys know what you guys think is going to happen from here, and I know what I think. I think I'm going to be right. I think you're going to be wrong, and we'll see. But thanks. And I was very gracious and thankful for the opportunity, and I went on my merry way.
Yeah, it's interesting because I'll tell you, I was very bearish also, obviously, and I fired myself and closed the fund at the end of 06 and returned assets. And, it would have been a painful 07 for me, too. So, on one hand, my trade-off, I guess, for making that trade was, hey, I missed the downside that came in late 08 and early 09, but it would have taken another 5-10 years off my life. Definitely being as early as I was, trying to manage that from that perspective. So I would imagine there was somewhat of a relief. And where are you now? You've written a book and you've got a whole new product. Tell me a little bit and tell the viewers a little bit about what you're doing, because I think it's a fascinating product, as I said before we came here.
Yeah, the whole thing started really, on the week after I got fired, because I said, look, I'm bearish and I'm going to write about it every single day. And I'm going to write about it the way that a real hedge fund manager writes about the market, what he's seeing in the market, upside, downside levels, catalysts, the calendar. Because I'd been on, at that point, I'd been on the buy side for a decade, consuming the sell side's research, or Wall Street's research, and at the end of the day, that it's a bit of a joke. They get you meetings, and there are a couple good analysts at a couple firms, but at the end of the day, the product's not a practitioner's product. So what I said to myself is, I'm going to write a note every single day about what I think is going to happen tomorrow, and the next day, and the next month, and then the next year, and I'm going to hold myself accountable to it, just like we were on the buy side. Because if we're not right, our investors are going to hold us accountable to it. So I felt like there was a huge void in the marketplace from a practitioner's perspective to show exactly what it is that we do. Like, what does a really good hedge fund manager, or a good, as I like to say now, what does a good risk manager do? And I'm not afraid to show it every day. So that's what I do every day. I start a product called HedgeEye, and that the word is basically implies what we do. We're a virtual hedge fund. We hedge, and we have our eyes open on all the different catalysts and quantitative levels and risks that are in the marketplace that people are talking about, that we're seeing ourselves. We show how we debate those topics relative to our own positioning. We're out there every day with a point of view. We show all of our positions live, longs and shorts, again, holding ourselves accountable in a way that is absolutely transparent as opposed to trivial. Right.
And what I like, Keith, what you've done, and you've got, what, 8 to a dozen people, analysts, kind of giving their insight. I like how they, give their levels. I like how they put their risk out there, and they lay out their scenario, whether it's a chart or fundamental or a calendar reason, something that they like. Again, I think this all makes sense. It's like, this is good. Like you said, this is how I operated when I was running my hedge fund. This is how I operate my personal book today. Here's what I'm looking at. Here's what, here are my thoughts. This is the way I always put it down. So I really like the way that you guys have done this. And again, it's very elegant, very sexy in the product and what you've laid out. And I trialed it for a couple weeks, and I got to tell you, I mean, it's something that makes a lot of sense, and And how long has the product been open now at HedgeEye?
Well, thanks for your compliments first. I appreciate that. We put a lot of time into it, and it's nice to see that my goal was always to have the pros buy into it first, because if you don't get the buy-in from the real players, it's not unlike ESPN. The real players know how to play this game, and if you can show how the real players play this game, more and more people are going to start to follow. So we've only had this product really out there for people to use in its current format for less than a month. Okay. We've spent the last couple of years really proving it up in the institutional community. Again, I left Carlisle at the end of 2007, so this has really been kind of the brainchild that's been in the works, and I put a lot of capital into it to make it look the way that it does, because I do think that the marketplace, is at a level, at a place at least technologically where they want something that is elegant that they can use on a practical basis that's real time.
Well, again, it's fantastic, and I want to say to people, check it out. It's at HedgeEye, and that's EYE as in the I. And the book is fantastic, Diary of a Hedge Fund Manager. Again, I would recommend that if you're at all in the inside of this business, you're looking to get into this business. Read both the book and check out the product, because I think what you guys are working on is quite unique, and there's not a lot that I can compare to in the marketplace. I mean, at one point maybe Dennis Gartman, Clean Miser, or write some good stuff for TheStreet.com that was actionable. I mean, these are true. What you guys are providing, I think, is real actionable ideas, and that's something that Wall Street runs in packs too often, and you get the same stuff over and over again. So I like how you guys are unique and running your own potential opportunity here. It makes a lot of sense.
Well, thanks. I appreciate it.
So again, that's it. I'm gonna cut this interview and wrap it up here with Keith McCullough. Again, check out his book, Diary of a Hedge Fund Manager.